Welcome to Forex.Today. This is our daily Forex trading strategy session. It's the 4th of November. Not only is it a Wednesday, an oil inventories day, but it's also another dumb prediction day, otherwise known as ADP. So, should present us another opportunity to trade. Currently, S&P 500 is up slightly. NASDAQ is up slightly. 10-year T-note unchanged at 2.22. Oil up a little bit at 48. Euro USD down 0.25%. CAC up almost 1%. DAX down 0.25%. FTSE up 1%. That's where we are. So let's get going. Forex.Today, today. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. So please always stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. My name is Wayne McDonell. I'm the Chief FX Market Strategist for TradersWay.com. An ECN that offers Forex, but also energies, metals, indices, and binary options. We meet every single day, a couple of hours before the U.S. stock market opens. It's also approximately London lunch, a good opportunity for us to get together as a community, share thoughts and ideas, as well as align our satellites. Every Monday through Thursday, we're here at 7:30 in the morning, and every Friday, we're at FX Street. This Friday is non-farm payrolls, another big employment report for the United States of America. And that will be Friday's non-farm payrolls will be my 114th month in a row of trading non-farm payrolls live at FX Street. I think that's 9.5 years. Is that about right? 9.5 years I've been just doing that one. Cool, man. So to attend these live events, please go to Forex.Today, click register, and then you'll find a list of all the webinars that you can attend right in here, and you can find an archive right in here. Also, throughout the trading day, there will be at least a dozen, very often more, Forex trading ideas posted every day. That's why it's called Forex Today. Many of the analysts that post these ideas are in the room today. No, they're not robots. They're real people. They're kind-hearted. They're thoughtful. They put time and effort into making these trade ideas public for you. Leave a comment, huh? Give them some feedback. You want to do some trading? I don't know. Anyone trading the Polish zloty today? They kept interest rates the same. You like the zloty? Yeah. Let me shut this. All right. So let's start with a marketable trading idea. What's your marketable trading idea? What does your brochure say, your fact sheet, when you hand it to a potential investor? What is it that you do? What does your fund do? Warren's like, the what? Oh, in regards to Jimmy's post, yeah. Come on, guys, give me your marketable trading idea. What is it? Are you ultra long something? Are you ultra short something? Remember, you're trying to specialize in a particular currency. Well, what's your specialty? Jimmy says short JPY. Okay. Has anything happened over the last 24 hours that we should be aware of in regards to the Japanese yen? Nikkei rise. Why? James says risk on. I think the world's going to get a little more complicated than that. That's what we used to have. Well, for example, the Bank of Japan, again, are talking about things like changing policy in Japan to influence, wink, wink, nudge, nudge, wage growth. And we've talked about this a bit last week, where last year, the Bank of Japan went to some of the largest employers in Japan and had them sign a document, a non-legally, a non-binding agreement, just to say, hey, we're big employers in Japan, and we want to work with the Japanese government and the Japanese central bank to pull Japan out of its 25-year recession, and we pledge to pay our employees more to help create this inflation. Well, guess what? That no one actually did that, but we're still talking about it, and Bank of Japan's talking about that, for example. So how does it all line up? If you have a job, that's good. Second thing is, if you are being paid more money or are offered a higher paying job, and you expect that higher pay to stay around for a while, which is important, because we know, right, economists know that if you get a bonus from your job, or the government just gives you an end of the year check, it's a one-time thing or a short-term thing, you spend it. But not on things that improve GDP. You just pay down your debt. You pay off your credit card. You're like, yeah, awesome. Get to pay off my credit card for free. Nice. And it doesn't do anybody any good except the credit card company, right? But if you believe it's going to stay around a while, you buy a nicer house, you buy a nicer car, you buy a nicer watch, you buy a nicer TV. At least that's the American way, right? So it gets translated into spending, right? Spending from the consumer side will increase GDP. Eventually, this will create an expanding economy, which would increase, inflation eventually, and so on and so forth, right? So that's what they're working on, and I don't know. Good luck. Chinese PMI, did you get that? 52, man, pretty good. Came out 52. Aussie trade balance. We did talk about watching the balance of trade out of Australia, right? We did talk about that, didn't we, in a recent webinar? Somebody volunteered, I think, to say they would watch it. What should we see if the world was a normal world? If we were in a normal, healthy world, what should we see? It's called a positive number, that's correct, a surplus. Thank you, Sean. We should see a trade surplus. Australia has been tickling the $3 billion trade deficit for quite some time. Well, let's be specific. For 17 months in a row, Australia has been running a trade deficit. That's kind of bad, right? But the number that came out today was 2.32 billion. Negative 2.32 billion. Yes, it's still a trade deficit, but it's the smallest deficit in 6 months. Interesting. Maybe we've troughed out. We'll have to pay attention. Let's, one data set a trend does not make. A wise and brilliant man once told me. So why don't we see if we can get a couple of these strung together? And if we do, that could be positive for the Aussie dollar.
10 minutes to the top of the hour here in New York, coming up on 800 Eastern, 1300 GMT.
So anyways, that's a good start. So we're looking at Japanese yen here. Daily. Let's move this daily. Okay. What's the first thing you notice? Euro is weak. Yes, thank you, Jimmy. Same thing to Ryan. Crazy Ryan. Yeah. That's interesting, isn't it? These are daily charts for the last 1, 2, 3, 4, 5, 6, 7 days in a row. CAD yen's gone up for about the same period. Pound yen's gone up. Last 3 or 4 days, Aussie yen's been up. And this has just been down. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. Almost since the entire month of October, Euro yen has been down. Yet, much of that time, the euro has been weak, or the yen's been weak. The thing is, the euro is even weaker. So Lindo says you can't short now, right? Well, you should have shorted it if that's what you wanted to do. Now, remember, I'm always going to ask you if that's what you want to do. If that's what you want to do, you need to sell at resistance. Okay? So that begs the question, where is the next level of resistance? So that should have been Friday or yesterday that you shorted that, if you wanted to short that. Okay, a little breakout, little pullback. Doesn't look like much there, it's a daily chart. Okay, but, this is your area in here, what that was shortable. So if you wanted to be a little, on the ball, you could kind of look for this right now. Okay. Come on now. Touch me, baby. Let's not make this one red. Royal blue. Sounds good to me, eh? Kansas City Royal blue. That didn't work out. Hang on. All right. So you can see according to the zigzag, you know, these are lower highs, right? There's a high, lower high, lower high, lower high. Okay? So that's weak, which means you could say, well, that's interesting because the way we started this is the Japanese yen is supposed to be weak, right? That's how we got to this. The sellable idea was weak yen. But then you can look at that and say, well, yen is weak, but euro could be even weaker. And then, you know, the trader in you, the monster inside of you, could just go in here on these euro trades and look for an opportunity to dump it. Let's put all of these back to dailies since the other one was daily. Down, 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 down. Cool. Yep. Cool. Go back to the yen. So which one is strongest? Which one is going up the most? Let's change these to hourly charts. Aussie. All right, cool. So now you need to, by the way, what do you think of the entries? Do you like those entries? Cool. So now what you should identify is, do you think Aussie yen is bullish from here? Then it seems as no, so then you wouldn't buy this, which is fine. If you do think it's going to be bullish from here, you should identify some levels of support in which you may consider buying. Now, do you notice that my language doesn't change from day to day? Important, isn't it? Are you a bull or a bear? I'm a bull. Do you buy at support or do you buy at resistance? I buy at support. Well, identify 2 or 3 levels of support in which you may consider buying. All right, we can do that. So there's price action here. You could buy here. Okay. What else could you do? Paul says, do you wait for the Stokes to come back into the cycle before you start trading? That would be more ideal, yes. $55 as support. Yeah, that's a long ways down. But yeah, that would be another one. A fib would be interesting, wouldn't it? What about pivot points? Now I'm gonna do. Remember, a couple of weeks ago, I asked you to trade on naked charts for a while and then find out what you actually miss. Remember? Like, don't trade your usual chart. Trade naked, and then find out what actually makes you feel awkward, right? You're like, man, I wish I had pivot points. Just need pivot points. And then add that and see where you stand. Okay? So now we got some pivot points. Let's go to a 4-hour chart. This purple area seems fairly important too, doesn't it? That's why I have it marked, and I have another one up in here. So who's asking about the daily? Artem, is that you? Who was asking? Oh, Isam. Yeah, so are you paying attention to this? This is what's bothering you? Yeah, okay, that might be true, but it's not the right thing to be worried about. Okay, what you should be worried about is more like this. All right, how do I do this? How did I have this? I thought I had another wick in here. Hang on. Maybe I'm wrong. Oh, there it is. All right, I got to go all the way back here. Fine. Well, we'll do it. Okay, that's what's going on. That's what's going on. Nothing's right, I'm told. All right. So it's more like that, not this sideways channel per se. I mean, you could tell yourself it's this. All right. But then ask yourself, what's going to move? What's going to move 300? No, probably even more than that. What's going to move 1 billion Aussie dollars? Okay. Do you think 1 billion Aussie dollars will change hands because of this pattern here? Oh no, look at the flag, blah, blah, blah. No, I don't think it's going to behave that way for that reason. But playing this out here as a lower low, lower high scenario, I know these pivot points complicate a little bit. It's hard to see in here, but you know what it is, or it should. Okay, so lower low, lower high, lower low scenario. Okay. But I'm okay. I already knew that was there. Okay. Well, you say only speculators. There isn't $1 billion worth of speculators. Well, maybe, but probably not. They're not working together. So I see that. I'm aware of it. I'm okay with it. I can't lose any money. And one of the things that put me into this trade was I was front running the stochastic cycle. We also knew there was a lot of Aussie news this week because we talked about it last week. We talked about the doom and gloom. People are saying, oh, Australia has to cut interest rates now because they're missing their CPI. Well, they don't have to do anything. So, you know, I'm almost front running the sky is falling idea, where last week the sky was falling and this week we find out it's not falling. So, you know, like, all right, if there's blood in the streets, maybe we start buying, right? But I'm looking at it more like this. Okay, M2 is the bottom, M4 is the top. We break out of this channel. I think what could happen is like maybe next week, you know, well, this week, let's say we get all the way up in here, then we have a significant retracement, and then we buy off this gray zone again the middle of next week. And we play, and it breaks out. If I'm wrong, it comes back, knocks me out, and I lose opportunity cost. Okay? James, it sounds like your channel is a pitchfork. Yeah, Felipe says, but I made some money on the swap. Yep. Not a lot, but something. So that's how I'm playing it. Like, again, I could be wrong, but that's how I'm playing it anyways. I've gone through the thought process, you know. Let's say this, on this more of a macro level, let's say the retracement here is a 50%, then that should get me way up into here, almost to where my target is. You see my order? So, I don't know. Let's see if I can let it run. Okay, so that's that. One other one we talked about, do you remember talking about correlating oil and the Canadian dollar, and then I don't want to short USD CAD, so I have to long CAD yen? Do you guys remember all these conversations? So I bought CAD. It's funny, huh? You're a little late. So this is what happened to oil. What should happen on the Canadian dollar? This is West Texas Intermediate Crude. I know it's not Canadian oil, but it's an oil market. So the Canadian dollar should appreciate in value based on this idea of oil prices moving from 42 to 48. What's my take profit for CAD yen? I'm never going to take profit. This one's, oops, what just happened? Did I move my stop buy and limit? Wait, I bought oil. I don't want to buy oil. Oh, come on. There you go. All right. Now what? What were we going to do? Oh, pivot point indicator name. Pivot point history. Okay. You see I have a whole cluster of lines near price. One of the things I'm looking at is yesterday's high, yesterday's low, and yesterday's close. That's how you draw pivot points, right? So if I was a swing trader, I would look to buy the 382. No, this is different than the pivot points. So I am including some daily pivot points and stuff just on the short term, because, you know, if I'm trading a 5-minute chart, that's how I'm going to look at things. So this is sort of like my scalping setup. I want to see daily pivots. I want to see fib levels, so on and so forth. So anyways, we talked about intermarket correlation. And if I thought oil was going to go up, CAD would go up. If CAD was going to go up, I had to choose sell USD CAD or buy CAD yen. Well, I said, well, I'm bullish on US dollar, so I can't sell USD CAD, but I can consider going long CAD yen, and so I did. I should be in here, right? Come on, I should be down in there. We might have even talked about that. You're a little late. Wow, Baltic Dry Index down again today. Wow.
Early yesterday in the session, we saw reports circulate that Democrats in the House of Representatives had formed a drug pricing task force aimed to promote affordable drugs. Today's report indicating that they've sent letters to various companies, including Valiant, which was already known that they'd received correspondence from senators, and Turing, but it also included Retrofin and Rodellis Therapeutics.
I'm about a minute away from the October ADP employment change, expected to be an increase of 180,000. That'll be compared to the prior 200.
Sure, Kareem, EuroCAD would be just fine.
Overall, we've seen the dollar maintain a firm tone here on some of the divergence themes. Again, this week's employment reports looking for more timing, more confirmation of a potential timing of a December rate hike by the Fed. We'll get the ADP in just under 45 seconds.
This is brought to you by TradeTheNews.com. It's an institutional level squawk service for all kinds of traders, including currency traders.
182,000, roughly in line with expectations. A slight beat there for ADP. Again, up 182,000.
Small business plus 90,000, large business plus 29,000, construction plus 35,000, and we did see a decline again in manufacturing minus 2,000. According to Mark Zandi, chief economist at Moody's, job growth as measured by the ADP is not slowing meaningfully in contrast with the recent slowdown in the government's data.
There for September.
Saying the economy is creating close to 200,000 jobs per month, and job gains are broad-based, with energy and manufacturing alone subtracting from the top line. Small business in particular are contributing to the labor market's solid performance, says Sandy.
All right. Now, the interesting thing about that is every subcomponent went up except manufacturing. And we know orders have been low and inventories have been high. And I was telling you that, oh, did you lose? I lost everything. Hang on. Some new Windows feature that decides to randomly shut down every chart I have. Every window. Hang on. I've lost you for a second. Hang on. Where are you? See, when you have 18 screens, when Windows decides to minimize everything all at once, it takes me a while to figure out where you are. So hang on. I don't think you're gone. Maybe you are gone. No, hang on. Thank you, Windows. There we go. All right, I guess I'm back. All right. Yeah, nice new feature for Windows. I guess there's a magic mouse click or something that says minimize every window in every application you have right now. Boom. Like, who would invent something so stupid? So anyways, I'm missing one of my trading platforms. There we are. All right, we're back. So anyways, we were talking about how I was using manufacturing employment subcomponents in all of the, we have the ADP, but also I look at ISM. Because we want to see money trickle down to the average person in the economy. And so why don't we use a factory worker? No disrespect, but okay. And right now, factory workers are losing their jobs. Why? There's been a slowdown in sales and there's been a slowdown in inventory buildup. There's been a slowdown in manufacturing orders in the United States. Now, maybe some of that is the stronger dollar, because a country that has an appreciating currency and expected interest rates to rise could possibly have a slowdown in exports, but an increase in imports. Okay. Cool. Up almost, 90 pips now on the euro dollar? Cool. Into something real. So lower, low, lower, high, lower, low, lower, high, lower, low, lower, high. Cool. This is the beginning of a cycle. It should stick for at least a couple hours. That gets us to about 10 o'clock. I now have 95 pips. I'm losing some on my Aussie trade though. Too bad. There, 95. Okay, so when we scalp the news, what's the general strategy? Oops. Even though I've been teaching this same strategy publicly for 10 years, let's make sure everybody knows. Why won't this adjust? There we go. What do? You identify the move, the direction the market wants to take in reaction to the new information. You wait for a Fibonacci retracement, and you sell somewhere between the 382, 618 Fibonacci retracement, and then, I don't know, your stop's fairly close, and then you jam your stop pretty quickly. So in this case, it did come back 382 and drop. And where did it fall to? The 1382. Now that that's happened, the next way to do it is scalp it on the 5-minute chart, not the 1-minute chart. And maybe you get a second chance on there. And then the next way is to watch it on the 15. You're a little late. Do 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 do. Do do do. So it wasn't a great number. I'd like to see a better number out of non-farm payrolls. Kareem, I published a report on exactly how I prepare for non-farm payrolls, and it's on FX Street. And I definitely use the Challenger report. So you go, I just typed in how to prepare for non-farm payrolls, and the first actual link, right? You can see Chief FX Market Strategist for TradersWay. That's me. And here's my report on how to prepare for and trade non-farm payrolls. Conversations have gone dry. Let's go on. All right. So that's ADP. well, it wasn't a great number. Last month was revised down. That's not good. I was hoping to see, something um, clearly over 200, like 230, 240, 250, 260, that kind of stuff. And why do we want to see a big number on non-farm payrolls? Right, the higher the number, let's say if the number is in the 200s, I'd like to see mid 200s, 240, 250, 260. If we get a really big number, um, it's not that the Fed has to raise interest rates in December. It's just that market participants are going to front run that. They're going to say, okay, Fed's going to do it now. No reason not to. Boom. And they'll put the money in the market on the assumption that the Fed will. Now, the Fed, if they've decided, they're going to raise interest rates no matter what happens. Okay? You see what I mean? They're going to do it anyways. It's less risk for market participants if they feel the data confirms that the Fed's going to do it. If it's doubtful, why put $1 billion to work if you could lose money? You're like, oh, well, I only lost 30 or 40 million. What's the big deal? That's a small percentage. Well, I don't care who you are, 30 or 40 million on a dumb idea gets you fired. Well, Rick, I'll repeat again why I had to change my opinion 6 months ago. The Fed said they were going to do it. The Fed said they were going to do it. The Fed said they were going to do it. Just recently, the Fed said they were going to do it. The Fed said they were going to do it. And unless the data is bad on non-farm payrolls in November and December, if it's just good and on trend, or even expect, then people are going to finally believe that the Fed's going to do it. But the Fed said they were going to do it. So now we just need to see that the world isn't dramatically different from the way the Fed thinks the world is. You see what I mean? All right. All right, so on the 1 minute chart, you guys got a 382 Fibonacci retracement. On the 5 minute chart, you guys got a 382 Fibonacci retracement. And then we go to the 15 minute chart. And we'll see if this sticks. But this shouldn't head down. If we're going to make a lower low now because of the 5 minute chart, we'll do it now. We'll head down to this midpoint psych level. Then we'll pop back up, and then we'll retrace on the 15 minute. We'll retrace. Wow, come on, man. There we go. We'll retrace into this area. I'll just, since the 1 minute did a 382 and a 5 minute did a 382, I'll do a 15 minute 382. So we head down there, we 382, and 382 predicts a 1618, and that gets us down to here, 108.80. So there's the rest of the day. Now, we do have a lot of Fed speakers talking today. And one of the things I asked you to look for is that they come out and they keep telling us we're going to, we're going to raise in December, we're going to raise in December, we're going to raise in December, we're going to raise in December. And that could also bring some dollar strength. Okay? Because the world is just waiting to be sure the Fed's going to act, and if they're sure, then they can start putting their money and build their positions. And remember, a professional investor could take 6 months to build their position. So they don't mind trying to jump in a couple of months early as long as they feel like their risk is justified, and they'll start tippy-toeing in, right? But a billion here and a billion there, pretty soon it adds up to real money. I'm sorry, Artem. Watch what? Their speeches? Yeah, I'll Google it. It's on their public calendar somewhere. Again, if you spend time, remember how you were going to spend 10 hours on the Fed websites? If you did that, you'll find that they actually publish their calendar, and there's links to the events if they're covered, and very often there's texts and that you can download and read. Very often you can download the PowerPoint presentations, and it's some pretty cool beans. Yeah, it's good stuff. Has anyone delayed their inevitable success? How many people said, "Yeah, sounds really good. I think someone, a professional, would spend hours and hours and hours just on the Fed websites. It sounds really good. I know it's going to lead to success, but not today. I'm busy. I think I'll delay this. I think I'll watch the football game instead, and I'll get to my unbridled success tomorrow." I want to be super successful, but I don't have to be super successful today. So I'll go ahead and delay. Right, but all that pain and glory, right, Artem, eventually leads to some pretty nice success, because now you're an expert and you say, well, there are 3 or 4 different resources in the world to get me something similar to a Fed funds rate. I know I've spent hours doing research, right? And so therefore, here's what I like to use. Right. And that's what makes you an expert, right? I mean, you can go on TV and you could say, well, Wayne McDonell told me this and Wayne says that, and in this situation, Wayne would do this other thing. And they're like, dude, but you're on TV and we're asking you questions. Who's this Wayne guy, right? So it's more like, hey, I've done the research. These are the tools that I like to use. Let me tell you what I think. And that's what I want for you, right? Okay, Linda says, what's the difference between the discount rate and the Fed Fund futures rate? Okay, the Fed Funds futures rate is an interbanking rate that only banks charge each other when they loan each other money. So throughout a normal business day, banks have all kinds of inflows of capital and outflows. Deposits are made, deposits are withdrawn. Deposits are made, loans are lent out. Deposits are made, securities are purchased. Deposits are withdrawn. You know, money in and out, in and out, in and out, in and out. At the end of the day, they're required by the Fed, it's a Fed requirement, it's law, the government requires that banks calculate how many deposits they have, and 10% of those deposits must be put at an account at the Federal Reserve. So the Federal Reserve is a bank for banks. So really what happens is banks now take in your money and they really park it at the Fed. So a bank at the Fed actually has accounts. Just like you have accounts at the bank has accounts at the Fed. Well, a commercial bank, they make money by taking in your money, paying you an interest for it, but you basically lent the bank money. Let's say they pay you 0.5%. But then they go out and they loan it to businesses and to individuals, like mortgages, for mortgages and stuff, and they charge those people like 5%. They'll pay you 0.5%. They'll charge these other people to borrow your money 5%. Well, you're like, that's not fair. Well, it is fair. First of all, you're liquid all the time. You can walk in and say, give me all my money, and they'll do that for you. But the problem is they made a 30-year loan to your neighbor. So now we got these sort of problems as money comes, short-term money comes in, short-term liabilities versus long-term assets. You can get yourself into a crunch where the bank might not actually have the cash. So a bank now, when they're in a situation like this, they have assets, but they don't have cash, and they're required to give you cash because it's your money. What they can do is they can go to another bank that has excess reserves. They didn't make a loan today to a bank. They didn't make a loan to a mortgage today, but they have some cash because some customers made some deposits. They have more than enough cash. They can cover the 10% requirement that the Fed has. Those are required reserves, but also parked at the Fed, they have some excess reserves. Total deposits minus required deposits equals excess reserves. Excess reserves can be loaned out in the form of corporate loans, in the form of mortgages. They could go out and buy government securities like a treasury, or they could lend it to another bank who just needs it for a day or two. That's the Fed funds rate. The interest rate of which one bank charges another for very, very short-term liquid loans. No one else can borrow this. It's just bank to bank. And it's called the Fed funds futures rate because the Fed funds rate is the rate charged on short-term liquid loans that one bank lends to another to ensure that the borrowing bank has enough required reserves parked at the Fed. They make sure they have enough cash. But because it's a bank lending to a bank, the interest rate is very low. In fact, there's a floor set. There's a floor set. Does anyone know the floor? It used to be 0. But the Fed has done something to make sure we don't get negative interest rates in the United States. So you can think about that. So now you ask what the discount rate is. The discount rate is the rate which the Fed charges banks if the bank doesn't have enough cash to cover their required reserve deposit ratio. Let's say a bank is short $10 million today and it's 5 o'clock at night, the banks are shutting down, they have to call the Fed and they're like, Fed, we're sorry to say that we're short 10 million in cash. We're good for the money. We got a bunch of long-term loans. They're all performing. Our balance sheet's healthy, but we're a little short on cash. Well, the Fed says, well, okay, good. Don't worry about it. We'll lend you the cash. But it's going to cost you some interest. And the interest rate is going to be higher than the Fed funds rate that another bank will charge you. But there's also this issue of like, if you're Bank of America and you needed money, why didn't JP Morgan lend you money? What's wrong? Does JP Morgan know something about your books that you're not telling us? So they'll say, okay, well, we'll lend you the money. It's going to be a little bit higher than the Fed funds rate, the Fed funds rate. It's going to be less than the prime rate, so it's discounted. It's the discount rate, the rate at the discount window. And the Fed will easily lend it to you. In fact, they are the lender of last resort. They'll always lend you the money. And, some banks give you a free toaster when you take out a loan. Well, when you take out a loan from the Fed, you get a free audit. They're going to audit your books. They're going to scrutinize your executives. They're like, you're not going golfing today. Park your helicopter and sit down and open your books. Feels really good, right? Yeah. Well, the discount rate traditionally, so we're not in normal times, Linda, but traditionally the discount rate is a full percentage point higher than the Fed funds rate. So if the Fed funds rate set by the Federal Reserve, or not set, but influenced and controlled by the Federal Reserve, if the Fed says the Fed funds rate is 2%, the discount rate in a normal world would be 3%, the prime rate would be 4%, and your mortgage is probably 6%. What's the prime rate? The prime rate is the lowest interest rate, the best rate that a bank would charge its best clients, its best customers. Okay? So you have the Fed funds rate, the rate which banks charge each other. You have the discount rate, the rate that the Fed charges its bank members. And then you have the prime rate, which banks will then lend out money to their best customers, which again would be very low risk for them, right? And then usually when you take out a mortgage, they might say something like, oh, it's prime plus 2. So the Fed funds rate could be 2, the discount rate could be 3, the prime rate could be 4, and if you get a mortgage, it's prime plus 2, then your mortgage is 6. And your credit card, oy vey. Let's not even talk about that. Okay. Yeah, Ron says you probably should take the fundamentals course. Because one of the things that Ron can do now, Ron can actually balance a balance sheet for a corporate bank because he's taken the course. Right? So I could say, hey, Ron, the Fed made an adjustment. The reserve requirement ratio is now 9% in the United States. And your bank has $22 million in deposits, right? $2 million in bonds, $2 million in excess reserves. And 10% is the old Fed funds rate. So you got the required reserves parked at the Fed. How much more money do you have to lend out as a bank manager now that the RRR has dropped by a full percentage point? But more importantly, as an economy, how much has the money supply grown? How much has the money supply in the United States grown by lowering the RRR? And then you're like, there's all kinds of interesting questions there, right? And you really should know this. I mean, I don't know what else to say. This stuff you should just know. Just like you should know how to scalp this news event. So now there's been like, I don't know, 3 opportunities to sell this. Either way, your stop should be at break even now, guys. And hopefully you get paid. I know it's just a scalp, but, you know, I don't know. There's not many pips on it, but whatever, right? Can't do anything about that. So anyways, will I see you tomorrow? Yeah, I really hope so. I look forward to us getting together. So peace on earth, may the pips be with you, may your profits be above average, and I'll see you tomorrow here at Forex.Today, and then on Friday at FXStreet.com. So peace on earth, may the pips be with you, may your profits be above average. Cheers.